Hi traders, if you've ever wondered how to spot market reversals before they happen, then this video is for you. Now in this video, we are just going to be breaking down trading reversal patterns, the key signals that help you catch trend shifts with precision. All right. These patterns work across Forex, stocks, and crypto, and mastering them can give you a serious edge. So if you want to sharpen your trading skills, hit that like button and make sure to subscribe for more expert strategies. Now let us dive right in. Reversal patterns form when price action signals a potential trend shift, either from bullish to bearish or from bearish to bullish. All right. These patterns help traders anticipate market movements instead of reacting too late. So, unlike continuation patterns, which suggest a trend will keep going, trend reversal patterns indicate a possible change in direction. All right. So, learning how to recognize them early can help you avoid bad trades and improve your market timing. Now, let us go over the most important trading reversal patterns that you need to know. Okay, let's go over the most important reversal patterns that you need to know. So we are going to be starting with the head and shoulders pattern. All right, we're going to be starting with the head and shoulders pattern. One of the most reliable reversal patterns is the head and shoulders pattern. It forms when a trend creates three peaks. All right, the trend creates three peaks: a middle high, right? A middle high, a higher middle peak, which is the head, is a higher middle peak, and then two lower peaks, which are the shoulders, right? The two lower peaks, which are the shoulders. So this signals that buyers are losing momentum and sellers are taking control. Okay, and you can see that this is what we call the neckline. So once the neckline is broken, you can see there's usually a reversal to the downside, just like what happened here. Then the next pattern we are going to be looking at is the double top and double bottom pattern. All right, a double top signals a potential bearish reversal. It occurs when price hits a resistance twice, like what happened here, and fails to break higher. So as a result of that, well, we usually have a reversal to the downside. On the other hand, a double bottom is the opposite. It signals a bullish reversal when price finds strong support at the same level twice. And you can see once that prevails, we usually have a reversal to the upside. Okay. So these patterns often lead to sharp reversals once price breaks key levels. Now, the next pattern we are going to be looking at is the engulfing candlestick pattern. All right. So we have bullish engulfing and bearish engulfing. Okay. We have bullish engulfing and bearish engulfing. So a bullish engulfing occurs when a strong bullish candle completely covers the previous bearish candle. We can see this example here. right? When the bullish candle completely covers the previous red candle, signaling that buyers are stepping in. Then on the other hand, a bearish engulfing occurs when a strong red candle it occurs when a strong red candle engulfs the previous blue candle. And you see that? So it signals a shift to selling pressure. These patterns are great for confirming reversals with price action. Okay, then we also have morning star and evening star. Okay, the morning star is a bullish reversal pattern that appears after a downtrend and signals potential recovery. Let's see if we can find an example of a morning star, a three candle pattern. A three candle pattern that is from, okay, I can see a morning star here. It's a three candle pattern, first of all a bearish pattern, then a small bodied candle, sorry, a bearish candle, and then a small bodied candle and a bullish candle. So it signals, a reversal to the upside, or potential continuation. So you can see that we had an example, sorry about this, we had an example here, the morning star pattern, and guess what, we had a move to the upside after the pattern. Then evening star is just the opposite. All right, evening star is just the opposite. Let's see if we can find an example. Evening star is just the opposite. Okay, you're gonna have a bullish candle, and then a small bodied candle, and then a bearish candle following, okay, around the, yes, we can see something like that. So a bullish candle, a small bodied candle, and a bearish candle, and usually we have, a decline to the downside after that. So that is an evening star, and there's a morning star. So you can, okay, is this it? No, 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 not that. Yeah, this and a morning star. So you can see that there was a continuation in the direction of, the bullish candle, and in this example for the evening star, there was a continuation in the direction of the bearish candle. Okay, so these patterns are most effective when combined, or rather when confirmed by volume and other indicators. Then finally we have wedges and triangles. All right, we have what we call a rising wedge. A rising wedge. We have what we call a rising wedge. Now, a rising wedge is a pattern where price squeezes, trying to form a wedge pattern. There's going to be like a convergence, although the trend lines will not eventually meet, but they will be moving in a converging manner before a breakout finally happens. And it's going to be rising. That's the reason why it's called a rising wedge. It's going to be rising up before a breakout happens. While a falling wedge is, and it's just the opposite. It's a wedge pattern that is, sliding to the downside. While the rising wedge is sliding to the upside, the falling wedge is sliding to the downside. I'm trying to see if we can find an example of a falling wedge. I don't know, is this no, that's not exactly a good example, because the wedge pattern, unlike the triangle, the wedge pattern, both trend lines are sloping. Yeah, both trend lines are sloping and they don't converge. All right, they are sloping but they don't converge. They don't eventually meet. Okay, so a falling wedge pattern, I'm just trying to see if we can find an example. Okay, I think this might be an example, but maybe not a perfect example though. But a falling wedge pattern is, a situation whereby the two trend lines, they are going down, right? They are aiming to converge somewhere, but before the convergence happens, there's usually a breakout. Okay, then triangles are patterns that indicate a build-up of pressure before a potential breakout in the opposite direction. Triangles usually converge. Yeah, there is usually we have a symmetrical triangle. Symmetrical triangle, you can see this one converged. There is usually the trend lines usually meet very close to the point of breakout. So this is a symmetrical triangle. There is a break. There could be a breakout to the upside or to the downside. Okay. Then we also have an ascending triangle. Ascending triangle is usually such that okay. Since I found it, let me just talk about the ascending triangle since I found an example. Okay, the ascending triangle is an example whereby we have a support level, and then you can see price will be making lower highs. So after that, we usually have a breakout. That's for descending. Ascending is just the opposite. You would have a resistance. Yeah, you would have a resistance, and then you would have price making higher lows to the upside. So, those are the examples of triangles that we have. So now that we've covered the top trading reversal patterns, let's talk about how to trade them effectively. Ensure you always wait for confirmation. Okay, never trade based on just the pattern alone. Wait for price to break a key level before entering, and ensure you combine with indicators as well. You can use volume, you can use RSI, you can use moving averages or any other indicator of your choice just to confirm the pattern's validity. And make sure you set stop losses. Okay, always protect your trades in case the market moves against you, and look for confluence. If multiple signals align, like a pattern plus a support and resistance level, the reversal is more reliable. So by following these steps, you'll be able to filter out false signals and make better trading decisions. Now, before we wrap up, let's just go over the key takeaways from this video. Remember that trading reversal patterns help identify trend shifts early. The most important patterns include head and shoulders, double tops and bottoms, engulfing candles, morning and evening stars, wedges and triangles, right? So always wait for confirmation, use indicators, and manage risk before entering your trades. If you found this video helpful, hit that like button and let me know in the comments which reversal pattern do you use the most. Also, don't forget to subscribe for more in-depth trading guides and hit the bell icon so you never miss an update. Thank you for watching, and I'll see you in the next video. Happy trading.